Hello, Troy White, Hoodoo Financial, and today I want to cover a real estate topic. What I want to discuss is the four aspects of wealth creation. And these aspects of wealth creation specifically are pertaining to real estate investing. So let's dive in. First, number one in my book for wealth creation, my favorite and the one that is most important to me is cash flow. So cash flow as it relates to real estate, let me list them and then we'll just dive in. Those four aspects are cash flow, appreciation, loan amortization, and tax advantages. So I'll explain what they are and then maybe we'll just dive into it for 5 or 10 minutes. So cash flow occurs fundamentally when you have purchased a property and you're basically buy and hold, and you have tenants in this property, whether this is commercial or multifamily or residential, single family, doesn't matter. But the whomever is occupying the property is paying you. That payment is cash flow. However, I consider cash flow to be that amount above your expenses. So revenue is everything that you're taking in, but the cash flow, the cash that's flowing to you, is the amount above your expenses. Expenses include repairs, maintenance, taxes, insurance, and the loan that you may have. You probably got to acquire the property. Appreciation. Appreciation is just the value of the property increasing. So you bought it when you bought it, it was 100,000, and slowly it's crept up in value. Now it's worth 110,000. Well, it appreciated by $10,000. That's what that means. Loan amortization. So how does that build you wealth? Loan amortization, what that refers to is as you pay your mortgage every month. So let's say you've paid the mortgage for 12 months. At every time you pay, there's a portion of that lump sum. You say you're paying $2,000 a month. Well, let's say for round numbers, hypothetically, 1,500 goes towards paying the interest. 500 is going towards paying the principal. So there's a principal and interest payments. You might hear it as P&I payments. So that portion that goes towards the principal every month is amortizing the loan. So as the loan amortizes, that means part of that principal is being paid off, and principal is ownership value to you. So if, let's say in that first scenario, you bought this property for $100,000 and you are paying every month. So what was I trying to get to? So loan amortization. So you bought it for $100,000 and I said you paid, the value went up 10, but let's not assume the value went up. You've just been consistently paying. And in that scenario, I said $500 is going towards the principal. So 500 times 12. So that's $6,000. So now you have $6,000 in equity inside the walls of that building. So meaning the loan as it amortizes, it is giving you more principal as your ownership. So loan to value, you now have more value. You own more of that property. So basically, the tenants are giving you value. They're paying your loan, and part of that loan is the principal amount. Interest is the cost of money. So the largest portion of your loan payment is going to repay for the use of the money. But another portion goes towards paying off the actual loan, the actual amount that you borrow. So you're just feeding it back to yourself. So that's what the loan amortization. Then we talk about tax advantages. So again, let me restate. These are the 4 aspects of wealth accumulation in relation to real estate. So the tax advantages. So you receive a tax break of some sort. That sort changes every year. The tax laws are never the same. You get a new crop of lawmakers, meaning the Congress and the Senate. They set the tax laws. So depending on how the economy is going or what belligerent president is in charge, they are going to tax the citizens in some sort of way. And usually they try their best to hide that tax in such a way that you don't feel it, but you still pay it. And so there are tax breaks and tax things you tax more on, and there are things that they'll give you a break for when with the intent to encourage you to spend money in certain ways. So they give you tax advantages for doing certain things. So the tax advantages in relation to real estate right now, at least, and in the recent past, you get an interest tax deduction, interest tax exclusion. That's what it's called. So that means, as back to what I was talking about, the principal and interest payments. So P&I payments, part of it is the principal, part of it is the interest. So that interest that you've been paying is actually part of that you get a break on. So you can claim the whole amount, but there's some calculation inside the tax code that determines how much of a return that's going to give you. So you may have had $20,000 in interest payments, so put $20,000 on your taxes. But the calculation as to what break you're going to get for that $20,000 you gave that you spent, that could change every year. But let's just, for round numbers, just hypothetically, to give you a simple explanation. Let's say you paid, let me boost it up. Let me say you paid $25,000 in interest over the year on your home or your investment property, whatever it is. Then you can claim that on your taxes. And for that 25, let's just say for round numbers, because I'm not a tax, professional. I just know about the taxes, right? So I'm just picking a round number and say for that $25,000 in interest that you paid, let's say you're going to get $10,000 back, as that's going to help you get $10,000 return on your taxes, tax return. So you get remember, part of the principal and interest payment is a principal. The principal is really going into your net worth. That's the increase every time the tenants pay the part of the principal of meaning P&I payments. The tenants pay you, you use that money to pay your mortgage. Your mortgage consists of P&I payments. The principal, the P, is what increases your net worth. The I, the interest, you get to take an interest tax exclusion on your taxes, and you're going to get some more money back, which more money increases your net worth. Those are the 4 aspects of wealth accumulation in relation to real estate investing. I don't really need to go no further than that. That's what it is, really simple and plain. And just to say a few words on it. So these four, just by investing in real estate, you are increasing your net worth in four ways: by getting the cash flow, which I'm encouraging you to do. And remember, the cash flow don't stop. Let me jump on that too. P&I payments impact your cash flow, because as the principal and interest is paid off, then, and you buy and hold this property for your legacy investors, then hey, at some point the mortgage will be paid, and all of the rents, remember, rents go up over time, they don't go down. So your rents will be going up. That means there's going to constantly be an amount over and above the required P&I payments that you are making. So right there, the cash flow is really helping you a great deal. And then back to the so that's the cash flow. But remember that as the cash flow is it may be increasing while you're paying your principal and interest payments on that loan. At some point, the loan will be paid off, and then the entire rental income is all cash flow to you. Remember, I said that the rents go up. So the say if you got a 30-year loan, on year one, if it's cash flowing to you, it might just cash flow $500, right? Well, you're going to receive this $500 for 30 years. But not only that $500, you are constantly increasing the rent, a reasonable amount, even if just to keep up with inflation. So let's say inflation is 3%, but you raise the rents 5% a year or every 2 years. Then you're not just getting $500. At the end of that 30, you're receiving a big chunk. So 5%, even if I said, like I said, every 2 years, that's 15 times. So 15 times you've raised the rent, and at some point the mortgage is paid off. So you're receiving that entire rental income in your pocket. And over those 30 years, theoretically, this property would appreciate. Now, specifically, investment properties and multi-units, the properties appreciate in value based on the income that it's receiving. So your proper management of this property, it's not like a residential home where the value is increased by the market because individual families are bidding up properties. People move and then a new one comes in, the price is higher. They move, their family gets bigger, they need a bigger house, so they sell that one for more than what they bought it for, and they buy another. And that's how residential properties appreciate, but multifamily specifically and other commercial properties, they increase by they appreciate based on your management of this property and your ability to collect rent and increase rent and maintain the property. So it's a slight difference there on how the properties appreciate. Loan amortization, all that what I was saying goes back to when you originally acquired the property. So when you originally acquired it, you must buy it right. You got to buy at the right price, because otherwise you could potentially be underwater from the beginning of your ownership of this property, and that's going to affect your the appreciation. That's going to really affect the loan amortization and your cash flow, and thus the appreciation, because your ability to maintain it, keep it, improve it, things like that. So in a real world sense, the loan affects each one of these categories. So if you don't buy right, then it'll throw off the whole deal. It'll just mess you up, put you in a hole. So buying right, to me, means buying it below market value. So how can I buy it below market value? Well, you're not looking for for diamonds, you're looking for diamonds in the rough. So, if for those who are out there acquiring properties for the affinity of being an owner of this beautiful property, hey, you must got a lot of money to throw around and a lot of money to burn, a lot of money to waste, because that's a fool's game. So you need to, if you're investing in property, you're trying to buy low and appreciate high. If you're selling it, sell high. So there are many techniques, many ways to find properties that are undervalued, below market value. And as an investor, that's your job, or else other people everybody would do it. And the tax advantages, those change from year to year. So that could be better or worse at any given time. But these four aspects are the ways you accumulate wealth via investing in real estate. Thanks for listening. We'll talk about it some more. Holla.